And right now we're bringing our man, Mr. Andy O'Rourke. Andy is from Direxion Investments, folks, and of course, I know many of you folks trade the Direxion products out there, whether we're talking about the Gold Miners Index, the NUG, the DUST, or the Juniors. They have a couple new products out here, which I would like to talk to Andy about. Andy O'Rourke, welcome to TFNN.
Thanks, Tom. It's great to be here.
Absolutely.
Appreciate it.
So, hey, you know, you have the, inside the gold market, you have the 300% daily vehicles for the gold miners bull and the gold miners bear, and you also have the juniors, okay, which, and, you know, of course, we have a lot of listeners that are in the metals market, and whether they're going into the ARCA index or the juniors, those are very popular. So tell us about, I see that you have a new product, and it's the 300% of the actual COMEX gold futures, right?
Yeah, that's right. Yeah, they've been out for a little while. It started back in April, but again, it's a leverage product, just like many of our others.
Yes.
3 times leverage exposure to the spot price of gold through the futures. So, you know, we're definitely like the idea of providing people the option to either get into the equities, you know, gold-related equities,
yes,
or the actual spot price of gold.
And, you know, what you state on your website on a continual basis is that these are daily investment vehicles. So when we look at the GLDL, okay, which would be the long gold 300 times COMEX, I guess that would be, well, I wouldn't expect it, but if someone owns physical gold, let's say they own 10 or 20 or 30 ounces, what seems to happen, Andy, and this is my take on it, in the gold market, is that on Fridays, because, you know, the market is closed, once we close, it's closed until Asia opens on Sunday night, that's when it's the most volatile. So that's a nice product to basically hedge if someone has physical gold and it actually want to get delta neutral.
Yeah, absolutely. I mean, I think there's a couple of ways to look at it. Yeah, I mean, a period of time where if you're looking for a little bit of pop for a real short-term trade, you could you know, take that in one direction using, you know, the products. Like, you know, to be clear, we're offering both the bull side of the trade and the bear side of the trade through the two ETFs.
Yes.
But
yes.
Also, like you say, certainly a way to hedge. If you think that things are going in a different direction, they're great vehicles for that, for sure.
Now, I want to switch gears on you because, you know, what we have had, you know, 2 or 3 weeks in the last 5 weeks is that the VIX, okay, the volatility index has basically spiked 2 different ways. You know, if we go back to July 16th, the VIX is at 1059. It goes up to 17, comes all the way back down here to 12 today. You have a product that it looks that it's really good for folks that want to stay in the market, but yet want some protection when the volatility gets higher. And I'm looking at the Direxion S&P 500 Volatility Response Shares, and the symbol's VSPY. Can you explain exactly how this product works?
Yeah, absolutely. I appreciate it. Actually, Tom, let me just quickly just step back for 1 second and just point out, because on the gold, the 3X gold products, I just wanted to quickly announce that we're actually changing the tickers on those for everybody. It'll take place on Monday. So GLDL will change its ticker to BAR, bar. And then on the bear side, GLDS will change over to BARS, so bar short. So I just want to make sure people know if they waited till Monday and started looking for them, they might have a harder time. So the long one, is the long one BARR or BAR? Just 3 digits, BAR.
Okay, cool. So the GLDL, folks, is BAR, and the GLDS will be BARS. Yeah, you know, I like how you just put the S's and L's on them, man. There's no seriously, because the S&P, it's always the SPXL and the SPXS. Do you know what I mean? It's very easy to understand.
Yeah, we have some fun sometimes trying to come up with good tickers, and as you know, in the ETF space, everybody speaks of them as in terms of their tickers. So we try to use some stuff that's memorable and easy for people to think of when they're thinking about a particular sector they want to get exposure to.
Yeah, like the FAZ.
Right. Another one. So yeah, exactly the point. I think a lot of your listeners, from what I hear from the call-ins and so on, they're certainly active traders. They love to use trading vehicles like that, ETFs in general, but certainly the leverage products. I think I definitely hear some calls often. But the other product that you alluded to a minute ago, VSPY, VSPY. I guess the way I look at it is it's another product that you can use. Think of it more as a buy and hold strategy.
Yes.
Because now there is some actual tactical activity going on within the strategy, but it's baked into the fund in this case here. So, one way you can think about it is instead of having to have the actual trader themselves think about when's the right time to get into the S&P, when's the right time to get out, or should I overweight, underweight, that kind of thing. This is a product that builds a strategy around trying to help you do that, so you can kind of, maybe focus more of your time on some of the other trading vehicles. And to give you just the background on how it works, and basically it's a product that looks at volatility in the S&P 500.
Right. When
volatility ratchets up, it will automatically reallocate the holdings and back away from fully allocated to the S&P 500.
Yes.
And when volatility drops lower, it's going to be fully invested in the S&P 500. So think of it as investment into the S&P 500 with a little bit of a downside protection, kind of an airbag for your ride.
What's so cool is that I was bringing up a couple days ago with one of the traders at Thinkorswim. One of the large funds had put on, and this came across the Bloomberg because they had to file it evidently, okay? They put on a $1 billion trade using put options for their, these were put options, but it was actually to protect their own portfolio. It wasn't basically, it was protected. So it's really cool when I saw this product that there's plenty of people that want to stay in the market, want to stay in the large caps, want to stay in the S&Ps. And it seems that the way the product works is that if when the volatility comes in, that the allocation will go into bonds, or a certain percentage that will go into bonds, right, to basically protect. That's
right. Yep.
Right?
Yep. Yeah, exactly. And I think I would even put forth that maybe even a simpler way, because you're buying one QSIP and not having to focus too much and watch real closely your different options contracts.
Yes.
So kind of democratizing access to this type of a strategy here. It's certainly ideas that institutional investors have used for years, but we're kind of baking that into an ETF and making it available. And really the premise behind it, Tom, is just when we see volatility spike, it's typically, historically, has been a precursor to a downward market. Whether it's a short-term tactical shift or whether maybe a longer one. So the idea is, as we see that, the portfolio is designed to adjust.
And what's really cool is that the person that owns the VSPY doesn't have to adjust, because you're doing the work inside it. What's wild, Andy? Isn't it wild that the definition of volatility inside the market is that it's going down? It's just like, I've always wondered, like, how does that work? Because, it's never, if the market goes up, 500 points, they don't say it's volatile, they say the market went up. But the fact of the matter is, we know that when volatility comes in the marketplace, most of the time it's always on the downspin.
Yeah, it's a precursor, like I said. I think if you look at it, and we have in some of our materials, we look at it that way. We show periods of the highest spikes in volatility and what happened in the market right there afterwards.
Sure.
And it tells that same story. So, that was, when we're building products here, we don't just sort of build them from the standpoint of, hey, what's the coolest product, and, just what do we think maybe there might be general requests for. We think about what are people looking to achieve in this case here, we're just looking for a smoother ride.
Yes.
And so we build products kind of with the outcome in mind.
Right.
And then hopefully when people look at them and they see that, yeah, that's actually what I'm more interested in is a smooth ride than I am trying to, just always expect that equities are going to run forever, which, they certainly have been for a while here, as we've seen, Tom.
There's no doubt. So we have a question from one of the listeners, right? So the question was, so the V-SPY goes up when the S&P would go up. Would that be correct?
V-SPY will be V-SPY looks at the volatility. So as volatility rises,
yes,
it will decrease its allocation to the S&P 500 and put the difference into T-bills.
That's right. And would you mind staying with us for another segment?
Oh, sure, yeah, no problem.
That's great. You stay right there. And folks, you can give us a call with any of your questions. 877-927-6648. Andy and I are coming right back, folks. Welcome back, folks. The Dow's up 66, Nasdaq's up 3.5, S&P's are up 7.5. My guest today is Andy O'Rourke from Direxion Shares, and we're talking about the V-SPY, VSPY. It's the Direxion S&P 500 Volatility Response Shares. Andy, this seems to be a great product for long-term investors, and in particular, folks, whether they're, have an IRA, a 401k, because in the aspect of longer-term investors, most times they don't want to be out of the market, period.
Yeah, exactly. Thanks, Tom. I mean, the idea is if you talk to people, I mean, what percentage of the investing public out there has some level of exposure to the S&P 500?
Right.
So many, almost
everyone,
all, in some capacity. So the idea is, here it might not be, maybe you're just looking for some sort of downside protection. So maybe you could use this and think of it as a smarter way to get exposure. To the S&P 500, maybe you pair it up with SPY, and just know that you have some portion of your exposure to the large caps set with a little bit of a downside protection feature to it. So it's just the idea is so many people have that exposure. Do you have everything in place? Even though we continue to see the S&P rise and rise, there's going to be a point at which it does take a turn in the other direction.
No doubt. And, I would say most of my listeners, all the Tigers and Tigresses out there, no doubt are used to the 300% products, which are daily investment vehicles. So I just want to get this clear, because this vehicle here is a long-term vehicle. It's not a daily investment vehicle, correct?
Yeah, that's right. I mean, there's exactly the idea is that you can put this into your portfolio. It does have a tactical aspect to it, as I mentioned earlier, because it's making that adjustment.
Right.
But it's making that adjustment so that you can hold it for an extended period of time. So, yeah, while people definitely know Direxion probably most for our short-term trading vehicles, the leveraged, 3 times leveraged products, we do certainly build other products as well, and this is just one example of them.
Right. Now, I want to switch gears on you for a second, okay? Because I do want to go back to, and folks, as you're over at TFNN, you're going to see the Direxion banner on the top and on the side. You can hit that banner, because we're going to get into some education right now, because when you're at TFNN, if you go into ETFs, okay, Direxion's been kind enough that we took what they have there for the 300% daily products. And on a continual basis, folks, we want you to read that and understand that, because they're great products when you understand how they work. So I'd like to talk to you about the education that you have at Direxion, and how you push out that their 300% product is a daily investment vehicle.
Yeah, that's right. I mean, first of all, it's about suitability. I think it's, make sure that you're the type of investor that's well suited for these type of vehicles.
Yes.
And it's not so much what your title is or, how many years of investing necessarily that you've got under your belt. It's more about, first of all, do you understand the products, how they work, the fact that they reset every day to get to that 3-to-1 ratio, and the fact that they are not expected to provide 3 times the cumulative return of their benchmark over an extended period of time. They seek a daily goal.
Right.
Doesn't mean you can't hold them for longer than a day. You can, but you need to watch them and understand what your level of exposure is at all times.
You know what's so cool was I think there's a lot of traders that love your products. What I really love is that once I got to really understand that they compound on the way up and they get defensive on the way down. And, you know, when you're reading that, folks, you got to clear your mind. But it's really cool once you really get that in your head. Because it's like, you know, in the 5th grade when they taught you, you know, a penny a day compounded, what happens to it? Do you know what I mean?
Yeah. And in fact, you know, there's some level of a myth out there that all the compounding that occurs with the funds is bad or negative. It's not necessarily true. The rule of thumb is when markets are trending, so you have either a smooth ride upward or a smooth ride downward.
Right.
Your returns will be generally better than 3 times the cumulative return of the benchmark. However, and where you see more people talk about it is when the periods of volatility for the particular benchmark, then you'll see that the returns can decay over time, because if you think about it, if you have a large up day, you're increasing your exposure exponentially, and then if you follow that with a down day, sharp down day after that, you have more sort of more punch that you add to that down day the following day, and you basically create a pattern where you're getting whipsawed around a little bit.
No doubt. And you know what's really cool, and you know, most of the folks that listen know I'm all about price and volume. And when I figured out that, you know, the compound is awesome on the upside, but I love the defensive. Once I figured out the defensive posture on the downside, I'm saying to myself, oh, this gets interesting, because of the fact the same way, if in fact something's been going down on a continual basis and it's getting to a smaller number, well, you know, it seems, this is my take on it, that my risk is a little bit smaller at that point. Inside that trade. That's what it really, you know, if I'm going to be right on the aspect of it anyway. But it's really cool once you really do understand the daily number one and that compounding and particularly the defensive aspect of it, you know. So it's really cool.
That's right. Yeah, and I mean, and it's based on the fact that it, you know, by objective, by requirement, they have to reset every day so that the total exposure is equal to 3 times, in the case of the 3X funds, the value of the net assets. So the idea is if you have a bull fund and we're talking about a downward trending market or any, you know, downward move, every time it goes down, it has to reset. So it will take some, you know, so to speak, money off the table each day, because it just has to, if you look at the math, and we have plenty of materials that look at that and show examples of trending up, trending down, as well as volatile markets. It does exactly what you say. When there's a downward movement, it is required to take some of the money off the table, but in effect, what it's doing is actually getting a little defensive at that period in time. Right.
And folks, as you're over at TFNN, you're going to see the banner, Direxion banner on the top and the side. Hit that banner, and when you come over to Direxion, well, the first place I'd love you to go, folks, is go right to the Education tab. Go to that Education tab. What you're going to see right there, you know, if you happen to be in the metals market, gold's going to be right up there for you. The leveraged and inverse ETF guide. Please download it and read it. It's an awesome guide. You'll really get to understand the product, number one, but because there's so many leveraged products out there, you'll really get to understand how these are put together and what they're all about. Andy O'Rourke, thank you so much. We really appreciate the great education, and you have a great day, safe day, and we look forward to speaking to you again.
All right. Thanks, Tom. I appreciate the time.
Okay. Have a great one. Have a safe one.